Welcome back, traders, to Alpha Market Meridian, the only channel where we turn daily market noise into precise, executable profit maps. I'm your head trader Eric, and today is a day for extreme focus. The S&P 500 has just printed a deeply suspicious close at 73.37, and the data we are seeing right now is not for the faint of heart. I'll cut right to the chase. The breakout above 73.70 has failed. We are seeing a textbook bull trap developing on the 60-minute chart, confirmed by a momentum divergence that is screaming for a correction. If you've been chasing this rally, you are about to get run over by a liquidation event. Here's exactly what I mean. Most retail traders see price at 73.37, just 28 points off the highs, and they think buy the dip. Professional traders see the same chart and think sell the rip. Why? Because the structure is breaking down. The last 24 hours of trading gave us a high at 7,385.02. Price couldn't hold it. This isn't just a failure. It's a failure from a level that was supposed to trigger a massive short squeeze. When price can't hold above a key breakout level, it inevitably seeks liquidity in the opposite direction. And that liquidity sits at 73.21, the overnight low. In the next 20 minutes, I am going to equip you with 3 precision strategies to trade this incoming volatility, including a high probability short setup that targets a 100-point move to the downside. But first, we need to define the battlefield, directly giving you the conclusion. The S&P 500 is shifting from a bullish trend dominance to a neutral, high volatility distribution phase. The daily chart remains structurally constructive, but the intermediate and short-term timeframes, the 4-hour and the 60-minute, are flashing sequential sell signals. The multi-timeframe agreement is breaking. The bull-bear line in the sand is 7,321.25. As long as price is below 73.85, and specifically below the 60-minute MA20, which is now capping upside, the risk is heavily skewed to the downside. A close below 73.21 confirms the trap and opens the gates for a violent, high momentum drop to 7,280, initially, and then the 50-period daily anchored volume-weighted average price, which sits much lower. I am outright bearish below 73.85, targeting that 73.21 break now. Let's get into the charts. Let's go deep into the technicals. I want you to pull up your 60-minute, 4-hour, and daily charts. This is the central diagnostic. First, the 60-minute chart. This is where the crime scene is. I want you to look at the moving average ribbon. Volume-weighted metrics, or just standard exponential moving averages. The 20-period MA on this time frame is at 7,352.81. The index is currently below that. But more critically, look at the 10-period MA at 73.09. It's rolling over. This is the first breath of bearishness. Now, here is what shocks me, the MACD. On the 60-minute time frame, the difference line is starting to curl away from the DEA, and the histogram bars are printing deeper red below the zero line. But the most lethal signal is the momentum oscillator. The chart data shows an RSI that is no longer making new highs. We have a clear swing failure. Price tried to push to 7,385, but momentum failed. This is a classic Type 2 divergence. This signal alone tells me the big buyers, the institutions, used the rally to sell into strength. They unloaded inventory to latecomers. Now, step back to the 4-hour chart. This is the battlefield for the day. The picture is even cleaner for a short. The 20-period MA on this chart is at 7,321.68. Coincidentally, this is the exact major support level, the low of the day. This is not a coincidence. Market geometry is not random. The 20 MA on a 4-hour chart acts as a trailing support for a sustained trend. When it's broken, the trend is over. The index has been riding this MA for days. Now, in the last hours, we see price perfectly respecting it as resistance. The official trend result from our multi-system analysis on this time frame is a clear, unambiguous bearish. Not neutral. Bearish. 7 out of the last 8 signals across DMI, ROC, and CCI are red. This is a systematic overload of sell signals. The Directional Movement Index is showing ADX flattening, which confirms the trend is exhausted, and the negative directional indicator is crossing above the positive. The momentum is officially with the sellers on this time frame. However, here comes the complexity. The daily chart. This is what the bulls are clinging to. The trend result on the daily is officially neutral, but the moving averages still suggest a bullish posture. The MA5 on the daily is at 69.49. The MA20 is at 63.83. Price is significantly above both. By all classic trend-following definitions, the trend is up. The structural support on the daily chart, marked by the MA40, is way down at 55.81. This shows you how overextended we are. But there is a crack in the daily armor. The MACD histogram on the daily has stopped rising. It's beginning to contract. We are not yet at a death cross, but the momentum is decaying. The KDJ indicator is in overbought territory at 73 and curling sideways. This is the early warning. When the weekly chart is overbought and the daily momentum rolls over, you get vicious, sharp corrections that shake out weeks of complacency in a single session. So, let's be blunt. The multi-timeframe analysis is fractured. Short-term bearish, intermediate-term very bearish, long-term neutral bullish. In this profession, we trade the path of maximum pain. The path of maximum pain right now is down, to shake out the weak hands who chase the breakout. The key support is 7,321. That's the 4-hour MA20 and the day's low. Below that, the next major support is the lower boundary of the recent ascending channel on the 4-hour chart, which comes in at 72.81. And if that doesn't hold, we are staring down the barrel at a full gap fill to 7,244, the 50-period MA on the 4-hour. That's nearly 100 points of downside potential, but why is this happening? Why does the price action feel like walking on eggshells? Let's connect to the news and fundamentals. The dominant narrative in the last 24 hours is a subtle but seismic shift in Fed rhetoric. The market has been pricing in a soft landing, a perfection scenario. The data out late yesterday, which I'm looking at right here, hints that this perfection is flawed. We are seeing a repricing of rate cut expectations, moving from 6 cuts this year to maybe 3 or 4. This is causing a stealth tightening of financial conditions directly as the VIX term structure begins to bend. The S&P 500 is not just an index of stocks, it's an index of liquidity. That liquidity is being questioned. Now, this is where our inter-asset matrix comes into play. We talk about this daily on Alpha Market Meridian, this market web. Look at Bitcoin. Bitcoin is trading as a high beta play on the Nasdaq, a risk asset perfectly correlated to the S&P 500. BTC is showing the exact same technical pattern, a failed breakout above a key psychological level, now consolidating below its 60-minute MA200. BTC's relative strength index is also showing bearish divergence. When the crypto code is suspecting trouble, the equity index usually follows. They are not decoupling today, they are confirming each other's weakness. The smart speculative capital that chases momentum is nervous. That's your leading indicator. Then, look at the dollar index. The DXY found a bid overnight. This is a direct headwind for multinational S&P 500. Earnings and risk appetite in general. While we don't have a collapse in the euro to US dollar or pound sterling to US dollar, which we cover separately, the DXY bounce from its own key support level is pressuring equities. There is a cross-asset risk-off pulse, subtle but detectable, and here's the deep institutional clue: ETF fund flows. The data I'm reviewing shows that while the headline buying has been strong, the large block trades, these are the smart money, the institutions, the desks moving in size, are hedging. We are seeing a massive uptick in put buying on the SPY, with a notional value significantly above the 20-day average. At 73.85, they sold calls and bought puts. They are not betting on a crash, necessarily, but they are aggressively buying insurance. We must follow the flow, not the headline. This sets up a cautious to bearish outlook for the next 1 to 2 weeks. My base case is a corrective move down to the 7200 to 7250 region. The primary risk that would annihilate this thesis is an unexpected, unambiguously dovish Fed headline or a peace agreement in current geopolitical hotspots that causes an instantaneous supply shock reversal in energy. Barring that black swan, we fade strength, alright. This is the moment you've been waiting for. The part of the video where I give you the exact architecture for profit. Here is strategy 1, the conservative, high probability fade. This is for the trader who wants to sleep well at night but still capitalize on the failed breakout. You are waiting for a confirmation. You are not chasing. Your entry condition is a 15-minute candle close below 7,321.25. And then, a subsequent 5-minute candle that fails to reclaim it, a bearish retest. This confirms the 4-hour support has genuinely been broken. Your stop loss goes at 73.53. This is a logical level just above the 15-minute breakdown candle's upper shadow and today's volume-weighted average price, which is acting as dynamic resistance. You are risking roughly 32 points. Your first target is the 7,281 level. That's the channel support I mentioned. This gives you a 1 to 1.25 risk to reward. Take half of your position off there. Move your stop to entry. Your second target is the 4-hour MA50 at 72.44. That's a 2+ to 1 reward to risk. This trade fails if price violently reverses and reclaims 73.75 on an hourly closing basis. In that scenario, we scrap the bearish thesis and reevaluate. But what if you are late to that first break? This brings us to strategy 2, the standard pullback. This is the bread and butter execution for the active day trader. The logic. The 60-minute MA20, which is now below the price at 7,321-ish, will act as resistance. Your entry is a limit sell order at 73.51. This is the intraday dead cat bounce level. The structural lower high. You combine this with a confirmation signal. Look for a 5-minute bearish engulfing candle at that price zone. So you're not just blindly selling a limit. You're waiting for price to arrive, then reject, stick your stop loss at 73.86. This is 1 point above today's definitive high. This is your structure level invalidation. You are risking 35 points. Your target one is 7,321. This is a rapid scalp. You grab 30 points of risk for a 1 to 0.85 reward. This seems counterintuitive, but the win rate here is astronomically high because you are selling into resistance to catch the move back to the range low. But here's the crucial part. After the first target is hit, you don't exit entirely. You trail your stop loss aggressively on the remaining position above the developing 5-minute high, letting the runner target 72.80. You are now in a risk-free position, riding a potential waterfall. This strategy uses the volatility. It respects the immediate resistance. It's clean, now, for the professional risk-takers among us, the seatbelt is off. Strategy 3. The aggressive momentum short. You are front-running the 7,321 breakdown. This is a high-risk, high-reward trade for a potential overnight gap-down entry trigger. We are currently consolidating just above 73.37. You see a push to 7,345 that stalls. MACD on the 1-minute or 5-minute chart curls over, and you get a series of lower highs. You get a market sell entry at 73.33, just below minor intraday support. Your stop loss is brutally tight at 73.47. You are risking 14 points. You are betting that any minor rally is dead on arrival. Your target one is 7,321, a quick 12-point move. Once that's hit, you move your stop to entry. Target 2 is 7,290. Target 3 is 7,254. This gives you a potential 80-point move against a 14-point risk. A nearly 1 to 5 risk-to-reward profile. Only attempt this if you are prepared for the stop-out. 3 stop-outs at this size are the cost of business for the one trade that pays for them all. You must understand this probability math, but before you enter a single unit of risk, we must talk about the real edge, survival. This section is the risk management beat. It is non-negotiable. The S&P 500 right now is subject to headline risk, an illiquidity risk, and an event risk spike. Your risk per trade cannot, under any circumstances, exceed 1 to 2% of your total trading book. If you are trading CFD or futures, you must know the notional value you are controlling. We are entering a phase of potential implied volatility expansion. This means the market can gap. A 35-point hard stop, if gapped through, can become a 60-point loss overnight. Never hold a position without a guaranteed stop into a known high-impact news event. The stop loss is not an emotional crutch, it is a mathematically defined point where your trade thesis is wrong. At 73.86, the bulls have reclaimed control. There is no hoping at that level. There is only execution. Trade small. Trade often. Make the law of large numbers work in your favor. Alright, let's wrap this up. Let's synthesize. Today's S&P 500 is not offering you a trend. It is offering you a trap. We have a clear rejection at 73.85. We have a systematic bearish convergence on the 4-hour time frame. We have a fundamental backdrop where the liquidity narrative is souring, confirmed by internals, confirmed by Bitcoin's proxy weakness. The core lesson. The break above 73.70 was a false auction. The market must heal this by discovering lower prices to attract genuine buyers. My core actionable takeaway for today: fade rallies. The burden of proof is on bulls to reclaim and hold above 73.85. Until then, we are sellers. And we are selling at the 73.51 pivot, looking ahead to tomorrow. The single most important event is the cross-asset reaction to the New York close. Watch the close. Does the S&P 500 close below its 20-day moving average on the daily? If yes, systematic trend-following funds will start liquidation programs overnight. Also, we have the Nikkei 225 opening. Remember our US dollar to Japanese yen and Nikkei 225 linkage. If the yen strengthens and the Nikkei gaps down, it will act as a leading index for a brutal S&P 500 futures open. The web is tightening. So here's the question I want you to answer right now in the comment section below. I read them every single day, and your clarity helps the entire community. Are you a seller at 73.51, or are you trying to buy the break of 7,400? Type your line in the sand right now. For me, it's 73.86. Where's yours? If this breakdown map added even one brick to your mental fortress, smash that like button. It tells the algorithm to prioritize actionable analysis over hype. Subscribe and ring that notification bell. We don't sleep on this channel, so you don't. Miss the move. Stay disciplined. Stay objective. This is Alpha Market Meridian. I'll see you in the next one.